Good morning, everyone. Today, let's start with the new standard, Ind As 40. Basically, it is investment property. So, what is investment property? So, as the term implies, it needs to be property. So, what is a property? What assets come under property? Do land come under property? Yes, land is a property. Building? Yes. So, do car comes under property? Car, land and machinery. So, as per Ind AS 40, only those two assets are property, and rest other assets are not covered. So only land or building or both. So land or building or both. These are property, right? So what does this investment means? So property which is purchased or constructed for investment purpose, it's investment property. So what's investment purpose? It's either to earn rental income or capital appreciation. So in short, it's not for own use. The property which you are not making use and which have purchased for rental income or capital appreciation. कोई भी प्रॉपर्टी क्यों खरीदता है या तो खुद के रहने के लिए फॉर हिज लिविंग और either for letting it out, right, which means rental income, or either wait is he's assuming that prices will rise and he will get a capital gain, so basically for capital appreciation, right? So if it is not for own use and if it is for rental income or capital appreciation, then it will be said for investment purpose, right? So and if at all if it's a property means land, building or both. So if it is property is purchased for investment purpose, it's an investment property. So this standard covers only land or building or both used for investment purpose, right? All other all other assets are excluded, and property which is used for own use is also excluded. Let's understand why they are excluded. Property, it may have two use, right? First of all, it may be land or building, and other than land or building, right? If it's a land or if it's an other than land or building, if it's used for own use, then it's obviously PP or intangible asset. Even it's used for investment purpose, whose scope is very limited, I guess, and hence it will also be PP or intangible asset, right? Because they are not covered in this. So either you need to show if it is an asset, you need to show either as a PP or intangible or based on its criteria, right? Next, land and building, own use, other than own use, right? So if it's own use, it's PP, right? If it's other than own use, then it's investment property. PP is covered in Ind AS 16, investment property Ind AS 40, 16 or 38, right? Done. So this is basically the bifurcation. Let's understand theory. So what is investment property refers to? Investment property refers to land, building or both. So all other assets which are other than land, building or both are excluded. This index has scope of only land or building or both. Okay. Next, first this land should be either owned or taken over as ROU asset, right? So owned by entity, ये तो समझ आ गया. So what is this taken over as ROU asset? What does this mean? What does this mean, ROU asset? Have we studied about leases in our CA Inter? Leases. What are the two type of leases which you have studied? So financial lease and operating lease, right? In case of operating lease, in the books of lessee, What we do in finance lease? Do we record the asset? We record asset in case of finance lease. We record asset. But in case of operating lease, we don't record asset. We just record rental income. Understood? This was the treatment which we have studied in CA Inter, right? In CA Inter, we have studied this adjustment. But Ind As 16, 116, Ind As 116 leases, it says us eliminate this concept of operating lease and finance lease. Basically, just do you know when lease is finance lease or operating lease, first of all? In C enter, when did we classify leases as finance lease or operating lease? So based on the period and based on the payments made, right? So basically, if lease covers majority of life of asset, right? Which is basically 75% we used to follow, or covered total payments, total payments were greater than, not greater than, major covers total cost majority, right? Total payments cover almost cost of asset, which is basically 90%. Then we used to classify the lease as finance lease, either of the condition. Yes, these two are major conditions which we used to check, right? So what happens? Say there's a building. Let's take an example. There's a building. Okay. So let's say Indigo and let's say Air India. Both have taken the same building. Both have taken the same building for on lease for 100 rupees monthly rent. Okay. Monthly rent is 100 rupees. They have taken lease for, let's say, 5 years. Right? Let's say 5 years. Now, useful life. Useful life is basically an estimate, right? No one can say how many years the building will stay, right? So basically, Indigo has estimated the useful life of building as 6 years, and Air India has estimated the building life as 7 years. Same building, same cost, same rent. Now, what problem arises is whether this covers the majority of life. 5 divided by 6 is basically 83.33%, right? So it covers majority of life, right? So Indigo will record this as finance lease in its book, right? Now here 5 divided by 71.42%, which basically doesn't cover entire life. Then hence it will record it as operating lease. Both are similar industry companies, right? Are they similar industry companies? Yes, but building is also same, right? So building is also same. But are they recording similarly in their books? No, they are not recording in the same way in the books. So is it, so if as a read user of financial statement, if you're reading financial statement of both companies, won't you get distracted, confused, right? Because one, see, confusion की बात नहीं है अभी. If you're when you're comparing assets of Air India and Indigo, let's assume all other assets are same, then whose assets will you will feel that Indigo, which company has more assets? Indigo, because it's showing financial lease and its assets also increases, right? When you compare debt to liability ratio, right? Debt to asset ratio, all these ratios will change, right? Right? But and Indigo income, Indigo won't record rent, right? Air India would have recorded rent. So Air India profit will also take a hit. So comparability is taking a hit, right? So comparability gets affected if we follow inconsistently throughout industry, right? So in order to avoid all this, what India said, eliminate this concept of finance lease and operating lease. In books of, let's see. So in the books of, let's see. just remove this concept of finance lease or operating lease. What you have to do is basically record ROU asset and record lease liability. We will study in detail in Ind As 116. Now just explaining for your understanding. This Ind As 16 क्या करता है? हटाओ ये सबको फालतू कॉन्सेप्ट, अभी सीधा ये लाओ ROU asset and lease liability. So what they will do, ROU asset will be recorded as present value of all payments to be made, right? Present value of all payments to be made. ROU asset will be recorded at this value, and lease liability will also initially be recorded at this value, right? It's a liability, right? आपको इतना पे करना ही है over the period. So every year finance cost will increase and you will get that payment, right? We have done in this deferred payment also, right? So ROU asset and ROU asset will be depreciated over its life of the or say period of the lease. तो ROU asset हो जाएगा जीरो, लीज लाइबिलिटी हो जाएगी वो अमाउंट जहाँ पे आपको पे जितना आपको पे करना है. So after the asset is removed from the books, ROU asset obviously after the lease period ends, ROU asset हो जाएगा जीरो, लीज लाइबिलिटी भी जीरो हो जाएगी बिकॉज आपने लीज का पेमेंट पे कर दिया है. अंडरस्टूड? So you have made a pay, ROU asset you have used, its lease period has ended, so it needs to get zero. Lease liability, you have paid payment for liability also over the years, so liability lease liability will also be zero. Hence, now both Indigo and Air India will follow this system. So both are comparable, right? Okay, now let's come back to our topic. So what they are saying that asset needs to be either owned or it needs to be taken over as ROU asset. यानी क्या बोलना चाहते हैं? It need to be either leased asset, either it needs to be owned by the entity or either it needs to be leased asset, right? And held primarily with the intention of earning rental income or capital appreciation or both. Understand? So held primarily with the intention of in making investment income, right? Which we have discussed, right? Investment either rental income or capital appreciation. Next, not held for own use and not held for sale. That property should not be used for own use. If it is own use, then it's PP. And if you are selling it in the ordinary course of business, then it's inventory for you. Maybe you're a real estate company, then you won't treat it. Real estate company wants profit, right? But they can't treat it as investment property. It's their inventory. Understood? So this is of let's understand some examples. What are investment property? Land or building held for long-term appreciation, right? Next, property held for future undetermined use. So this point also needs to be understood. This important point. अभी कोई प्रॉपर्टी पड़ा है अपने पास, we have a property either land or building, we have not decided whether to use it for own use or whether to keep it for investment purpose. If we have undetermined use, say we have not decided on how to use it, then we will simply classify it as investment property. So if there's a property and if use is not determined, then it's an investment property. And if they have determined use to make it for to use it for capital appreciation, then investment property. If they are determined to use it for PP, sorry, if it's determined for own use, then it's PP, right? Next, property given out on operating lease. So operating lease is basically to give earn rental income, right? Here, what we have studied in the books of lessee, right? In the books of lessee, you will record these two, ROU asset and liability. But in the books of lessor, still the concept continues of operating lease and finance lease, right? Yes, lessor will still record because lessor book, just understand why lessor will record like this. Lessor, if it is giving only for 1 year lease, then lessor won't remove a book asset from its book, right? Right? They should lessor should didn't remove, right? Because it is only given for rental purpose. So operating lease it will appear as operating lease. And if at all it is given for more than all those two conditions, then we'll record it as finance lease because lessor has no rights. Almost it has no rights over that asset. Whereas it may can have rights and obligations towards this asset in operating lease. So when there are rights and obligation, asset will continue to appear in our balance sheet. When rights and obligation are majorly transferred, then asset will be de-recognized from our balance sheet, right? So in which case do you feel it's an investment property? if someone has given for operating lease, then it will be investment property. Finance lease यानी asset ही नहीं है तो investment property कैसे record करोगे? Understood? If at all there's no asset, then how will record it as investment property? So property given out on operating lease, right? Next, vacant property intended to be leased out under operating lease. So property अभी vacant है, so you have a vacant property, but you have determined that I will use it to give it as lease to someone else, operating lease. Then in this case also it's an investment property. Property under construction which is intended to be used in future as investment property. So even property is under construction and but you have decided that I will use in future for investment purpose, then it's an investment property. So either land or building held for appreciation, or property for future undetermined use, or property given out on operating lease, vacant property, and property under construction. Right. Now let's say I have a car. I have a car. I have two cars. Say one Mercedes and one Audi. I have decided Mercedes I will use for my office use, and Audi I will use for because I believe say not Audi, it's Range Rover, sorry Rolls Royce, right? Rolls Royce. I believe that since Rolls Royce uses releases only limited stock, I believe it's great for investment. If I purchase Rolls Royce and sell it after 2 years, sell it after 2 to 4 years when I get a good price, I may make gain from this Rolls Royce car. So first case, whether it's a PP or investment property. So first case it's PP because it is used for office purpose, which means own use. And the second case, so if at all if you're saying it's Ind As 40, then you have misunderstood the class till now. Because what's Ind As 40? It's basically its standard called investment property. What does property means? Property means land, building, or both. So whether Rolls Royce is land, whether Rolls Royce is a building, whether land Rolls Royce is land and building, then will it be covered in Ind As 40? No, it is PP and it will be covered in Ind As 116, Ind As 16, right? Okay. So when I am saying that I will sell this car, then you might have got a doubt that why it's not classified as non-current asset held for sale, right? Held for sale, Ind As 105, right? So why it is not classified under non-current asset held for sale? Therefore, basically, whenever you purchase an asset, ultimately you wish to sell, right? Ultimately, any asset will be sold or dismantled or somewhere. So whether we need to check for ultimate use or current use. Ultimately सब asset बेचने वाले हैं, right? Now you purchase the machinery. Ultimately you'll sell after 10 years, 15 years. So shall I record from today non-current asset held for sale? No, because we should not say ultimate use. Now current use is my to produce inventory. Now in this case, say Rolls Royce. First of all, Ind As 105, it says that for an asset to be held covered under this standard, sale must be highly probable. Sale must be highly probable. तो most likely sale हो जाना चाहिए. When I'm saying that I will sell after 2 years, 4 years, whenever I get a good price, I will sell. So do you think sale is highly probable? I will make sale only when if at all I get a good price, right? So good price आ भी सकता है, नहीं भी आ सकता है. Sale is not highly probable here. When I say my machine life is over, so कितना भी price हो, I will eliminate it, right? I want to get new machine. So sale is highly probable here, right? Understood? इसके भी conditions है. Say I need to search buyers. I need to actively search buyers, right? Actively search buyers. And there are 2 3 conditions which we'll study in detail in this standard. But Basically, did you understand why it's not Ind AS 105? राइट। अगर कोई एसेट का तेरा प्राइमरी पर्पस ही है कि मेरे को बेचना है, तो इधर वो इन्वेंट्री होगा और इधर इट विल बी नॉन करंट एसेट हेल्ड फॉर सेल। बट योर प्राइमरी पर्पस इज नॉट सेलिंग, your primary purpose is either capital appreciation or investment purpose, then it's investment property. And if your primary purpose is its own use, then it's pp. Understood? Now, employee occupied property as used as staff welfare. So employee occupied property, is it own use? Yes, business use, own use, and it will be pp. So it's not an investment property. Got it? Owner occupied property, not an investment property, right? pp, property held for sale in ordinary course of business. Ordinary course of business is inventory, right? Property lying vacant, but the intention is to use for business. And if intention is used for investment purpose, then investment property. Understood? Now, property under construction or vacant property. Property under construction or vacant property. अभी तक अपन ने कुछ discuss किया था, right? So, under construction property or vacant property, if at all we intend it to use for investment purpose, then it's investment property, right? Actual use नहीं देख रहे. Actual use has not begun, right? Because it's vacant property, which means that actual use has not started. And property under construction, so construct हो रही है, अभी भी actual use has not started. So we can only just intend कि future में ऐसा करेंगे, we will do something in future. So based on your intended use, the property will be recognized today as either PP or either investment property. So what do you think? For initial recognition, property will be recorded at cost or fair value? Generally people tend to confuse that investment purpose के लिए, so we need to record this as एकदम fairly, we need to record it as fairly. So people think that yeah, investment property will be recorded at fair value, but that's not the case. Investment property is always recorded at cost. Only cost model is permitted here. So with this we have discussed already. Property under construction of vacant property, if intention is for own use, then it's PP. If intention is for investment purpose, which is rental income, capital appreciation, or both, then it's an investment property. If intention is undetermined, then it's an investment property, right? Next, own property, own use, PP. Operating use, operating lease. So you are giving it for operating lease, which means you give for earning rental income. So it's an investment property. Held for sale in ordinary course of business. So it's your inventory basically, because you are selling it in your ordinary course of business. Finance lease, basically in finance lease you won't classify it as investment property, nor you will record it as PP, because asset is eliminated from your book in case of finance lease, right? You don't own the asset now, because majority of life or majority of the payments is made by the lessee, right? So lessee is recording the asset, and we won't record the asset in our books, we will just de-recognize it, right? If he fails to make payment, yeah, then we'll record back the asset. Yes, that we'll study in detail in our Ind AS 116, right? So finance lease is basically no classification, because we just de-recognize the asset. Asset is de-recognized from the books, therefore no classification, right? If question does not specify operating lease and finance lease, and just say lease, assume operating lease as finance lease is equal to equivalent to sale. अभी क्वेश्चन में लीज आया just, if they are not specified whether it's operating lease or finance lease. Operating lease is for investment purpose, and finance lease is equivalent to sale, right? Because we are de-recognizing it as asset, so it's equivalent to sale, huh? So if question doesn't specify anything, then we will assume this one, because in this, why they would specify something which we want to de-recognize it, right? So this way. Next, now property has both use. Let's say I own a building. This building have 4 floors, right? I own a building. My building has 4 floors. I'm using the top 2 floor for my own use, and I wish to let out these 2 floors. So now whether this building as a whole is investment property or whether it's a PP, whether it's an investment property or whether it's a PP. Okay, so according to you, it's basically both, and you need to proportionately allocate it, right? So whether or not it can be proportionately allocated, it will be depend on whether you can sell it as a individually, right? Whether you can sell this floor. Yes, you can sell this floor to someone. You can sell this floor to. So hence, if at all you can sell it in on individual basis, then you can record it as proportionately. If at all sale is not possible, say अभी एक flat है तुम्हारे पास, you have one flat. In one flat you have 4 rooms. Okay, so you are making use of these 3 rooms for your own use. You have one fourth room. Say you have let out this room to someone. Whether can you sell this particular room without selling the flat? No, you cannot sell it, right? So in this case, you will record it as PPE only. But here you can sell someone, right? अगर इधर समझो एक घर है, हर एक फ्लोर पे एक घर है, तो ये घर तुम किसी और को बेच सकते हो, right? You can sell this house to someone else, right? Without any. So you can what you can do. So now building is 10 crores. You can equally divide this, say 2.5 crores. If at all each floor has same value, you can equally recognize it, right? So you will record 5 crore as your PPE and 5 crore as investment property, right? In this case, entire 1 crore will be recorded as PP, right? Now, let's say you got one room, one flat. This flat, let's say hypothetically, it has 100 rooms. Say it has 100 rooms. You have just used one room just for accounting purposes, right? Say अभी ये room में कौन आ रहा है कौन जा रहा है ये सब for to maintain data. You have used just use this room. Say library type है हर एक room एक library, okay? So you are maintaining, not say it's not for business purposes. You have let out this, right? You have let out each room separately, and one room you have taken it for your use. Now, whether it will be a PP or whether it will be an investment property, we have let out 99 rooms. We have not. We have used only one room. You cannot sell. You cannot sell that one room. Then so so you are saying that it's a PP, right? Because we have made on it. Basically, investment properties standard says that if your own use is insignificant, so if your own use is insignificant, then you can record it completely as investment property. Understood? First, whether if at all we need to check insignificant, they have not defined insignificant यानी कितना. So if it appears, question में देंगे mostly they will give in question. Otherwise, we will just check whether it's very low. If its use is very insignificant, then we'll call it as investment property, right? Now let's say एक floor पे we have 100 houses, okay? 100 houses. 99 are let out, and one is used for own use, own purpose. Then whether it's a PPE or whether it's a investment property. So you are saying that 100 houses are investment property, right? So that's incorrect. 100 houses are 99 is an investment property because you can sell this individually, right? Houses. So if you can sell this individually, then 99 will be recorded as investment property and one will be recorded as PP. Understood, right? So property with dual use. So both parts are separately saleable. If both parts are separately saleable, both parts should be separated and the proportionate amount should be taken to PP and investment property respectively. right? If both parts are not separately saleable, no proportionate separation is permitted. The entire property should be recorded as PP unless own use component is insignificant. Okay. Unless given in the question, we will assume that the owner occupied part is significant and hence classification would be PP. Understood? Right? So let's move on to accounting of PP, investment property. So accounting will be almost will be same as PP, right? We have learned concepts such as deferred payment, barter, right? All these concepts of PP will equally apply to Ind As 40 as well. But in PP we have both cost model and revaluation model, right? But in case of investment property, you can follow cost model only. So only cost model is permitted. Understand? Here you cannot follow. So only cost model is permitted. Here you cannot follow revaluation model. However, IFRS permits revaluation model. So we have discussed about IFRS in our first class, right? IFRS permits revaluation model, but Ind As doesn't permit revaluation model. It says that you need to follow cost model only. Whether do you think depreciation will be charged for investment property? You are not making it for own use. Whether depreciation will be charged? Yes. So many people get confused here that investment property we are not used it for our own use. Then why we will charge depreciation, right? But just understand whether or not you are using it for own use or not, प्रॉपर्टी विल गेट डिप्रिशिएट बिकॉज प्रॉपर्टी तो बिल्डिंग तो अभी लाइफ उसके 10 साल ही है अभी तुम यूज करो नहीं करो उसका तो खत्म हो जाना लाइफ तो बिल्डिंग नीड्स टू गो गेट टू जीरो राइट लैंड will whether will we depreciate land? No, whether it's a PPE land or an investment land, we will never depreciate land, right? So depreciation will also be a charge on investment property based on its useful life. Understood? Disclosure. Fair value needs to be disclosed for an investment property in the notes. So we are following only cost model, right? So investment property will appear at cost in our balance sheet, and we will give a note in notes to accounts that the fair value of my investment property is this much. Understand? We won't show it as fair value, but we'll give a note regarding fair value. So in case fair value cannot be determined, reasons for the same needs to be disclosed. तो यानी अभी fair value अपना mandatory है. Every balance sheet date we needs to give fair value. अभी जो revaluation when does revaluation happens? We have studied in Ind As 16, right? When does revaluation happens? When asset is not of volatile nature, it may happen every 3 to 5 years, right? If it is volatile nature, at each balance sheet date, right? So if it is not abhi investment property and it's not a volatile nature, then when fair value should be calculated? Wrong, incorrect. So whether or not it's volatile or not volatile, every year at balance sheet date you need to give fair value, which means that you need to calculate fair value at each balance sheet date, right? Because disclosure is mandatory. If you are not giving disclosure, you need to give reasons. Say my land is in such remote area, I have only one plot is there and that is also of mine. Then you cannot calculate the fair value because no one is going to purchase it, right? Because it's in remote area. Understood? So such a disclosure of fair value is not required under Ind As 16 PP. So whether if you follow revaluation model or cost model, you are not required to give any disclosure regarding fair value, right? In PP. So all other principles for initial recognition, barter, deferred payment, subsequent expenditure, depreciation remain same as PP, except that revaluation model is not permitted for investment property. Understood? Note 1. What is the note? For the purpose of disclosure of fair value, valuation should be done by independent valuer using internationally accepted valuation techniques. So valuation should be done by independent valuer. You cannot appoint any person from the company to do valuation, and it needs to be compulsorily done using internationally accepted valuation techniques. Next, further, the technique used, assumption used for valuation should be disclosed. So along with fair value, you need also to disclose technique How do you arrive at fair value? What are your assumptions, right? What are your assumptions? What are your techniques? How did you arrive at your fair value? We need to disclose all this, right? So reclassification. Now, अब ये reclassification क्या होता है? What is this reclassification? Say now you are using an investment property. 2-3 साल आपने भाड़े पे दे दिया. Now your office work has expanded. Now instead of giving it on rent, now you are using it for own use, right? Before you was giving it for rent for 2-3 years. Now your office work expanded. Now you are using it for own use, right? No, before it was a investment property because you have given for rental income. Now it's become a. It can happen very well. Is it possible or not? Yes. So whether you will record it retrospectively or prospectively, that change prospectively because in the initial year it was investment property. I literally get it for earning rental income. I didn't use it, right? So in the initial year it was investment property only, right? Now it has become PPA. So from now I will change. I'll change it, right? Now let's say initially it was investment property. ठीक है, तो इन्वेस्टमेंट प्रॉपर्टी कौन सा मॉडल फॉलो करता है? कॉस्ट, कंपल्सरी कॉस्ट मॉडल. So now investment property is classified to PPA under cost model. So इसका WDV let's say is 100 rupees. So now this PPA will be recorded at same WDV 100 rupees, right? Now investment property, its its fair value is 120 rupees. It will be recorded. Now let's say WDV is say 100, fair value is 120. Okay. So in this case, we'll record that cost as 100 rupees. Now investment property is based on cost is taken to PP based on revaluation model. PP is classified using revaluation model. Now will you record PP at 100, 120? So what standard says कि 100 पे record करो. This investment property का cost WDV will be PP of WDV. From now on you revalue. Understand? For reclassification just take the investment property value, right? Revaluation तो आपसे होगा ना, because now it has been a BP. So from now you will revalue, right? So from now on, you will do your evaluation based on 2 years, 3 years, 4 years, 5 years, anyway, right? Upward evaluation, downward evaluation, right? Now, let's say it was a PP initially, which is measured at cost model, right? Now it has converted to investment property at cost model. Obviously, there's no option here. So say इसका भी same 100, 120 वाला scene है. 100 is WDV. Then investment property will be recorded at 100, right? Now PP revaluation model वाला same 100, 120 वाला scene है. Then this investment property will be recorded. अपने books में क्या दिखेगी ये property? Till now we are using it as PPA. So what value will appear in our books? Whether 100 will be appear or 120 will appear. 120 because it's a revaluation. So this is not WDV. So this cost at WDV it will appear at WDV only, right? So our WDV after revaluation is 120 basically. So whether it will be appear at 120 in our books or 100, 120, right? And let's say revaluation surplus balance is 20 rupees. Okay, so revaluation surplus balance is hypothetically say 20 rupees. Now at what price will investment property will be recorded? If you record this investment property as 120 rupees, तो revalue surplus में balance रहेगा, वो eliminate हो ही नहीं, इसका नाम बदल जाएगा ना, right? से now this is balance sheet, right? PPE was showing at 120. Revaluation surplus was showing at 20. Right. Now we have changed this to investment property 120. So what reader will get assumption? Why they don't have PP? They have only investment property. Then why the revaluation surplus is appearing liability side? It shouldn't appear, right? Because revaluation model is not permitted in investment property. Then the revaluation surplus आए कहाँ से? How did they get revaluation surplus? So basically, investment property will be recorded net of revaluation surplus balance. So 120 minus 20, 100. So this will be eliminated and investment property will be recorded at 100. Understood? So what will be the entry? Investment property debit 100, right? Revaluation surplus, which is a credit balance, will close by debiting it. Revaluation surplus debit 20 to PPE, which is 120. Got it? Clear? Okay. So reclassification is permitted only if there is change in usage of asset. So this is also an important point. Reclassification कब होगा? Only when there is change in usage of asset. Whether they have talked about change in intention of usage of asset? No. So actual usage होना चाहिए. Actual usage में change होना चाहिए. See, like आज आप when you today you are doing some job in some say XYZ company, you are dissatisfied with the work. So you're like, I need to change my job. So will you record yourself as employee of other company? No, you won't record it unless you have changed to that company, right? So here also change in usage of asset. Usage needs to be compulsorily changed. Just say you are owning a building and you are using it for own use. Okay, so you are saying that my business will get over by next month March. Okay, so from April I am going from say I'll my business will completed by September. Today you are in February. तो मेरे को वैसे भी उसको from October I'll use it as investment property. So let me record it as investment property because my intention to use have changed. But industry no, not intention to use. Your actual usage needs to change. You will record it as investment property from September, right? Not today. That is in case a property was earlier held for own use and is now given on operating lease, then the entity should reclassify the PP to investment property, right? Then it should record. Mere intention to change usage is not sufficient ground for reclassification. So बोल रहे यानी if just your intention changes is not sufficient ground for reclassification. Your actual usage needs to be changed, right? Not only just the intention. The reclassification would happen on carrying values of the asset on the date of reclassification. So carrying value पे होगा revaluation, right? Which is WDV. Revaluation surplus already existing. So if revaluation surplus, if any, will be eliminated. Should be eliminated against carrying value of the asset, right? Once the initial recognition classification is determined, a subsequent reclassification can only happen if there is an actual usage, actual change in use. So there should be actual change in use. Mere intention is not sufficient, right? Then okay. So last topic of this series. Now let's say X Limited is a holding company. It has subsidiary Y Limited. So X Limited is a holding company. It has Y Limited as its subsidiary. X Limited has one building. It's not using it currently, so it has given on rent to Y Limited. Can it give it to rent? Yes, दे सकते. So for X Limited is earning rental income, right? Y Limited is making own use, is using building for its own use. X Limited will record it as investment property, right? Because it's earning rental income. Y Limited, Y Limited may not record any. Y Limited is it's an ROE asset. Okay, so they are given for operating lease, right? Operating lease. In the lessee book, there is no such classification of operating lease and finance lease. It will record it as ROE asset, and basically it will be right. It will be recorded as ROE asset. Whether this ROE asset is an investment property, No, because it's not used for investment purpose. It's basically used for own use, right? Understood? This is use own. Now, in consolidated balance sheet, CFS of X Limited, right? X Limited is holding up. So how this property will have appeared? Whether it's a PP or whether it's an investment property or whether it's both. So X Limited will prepare his own SFS, right? Y Limited will also prepare its own SFS. Okay. CFS यानी दोनों मिला के बनाएंगे, right? X Limited and its subsidiaries, CFS. So when you see property used by Y Limited for CFS, it's used for own use only. दिख रहा है ना? Y Limited its own use, right? But Y Limited is inside X Limited, right? For in CFS. So it means it's used for own use. So own use, and hence it will be classified as PP. Understand? As a company as a whole, if you merge all companies, then that property is used for one of your company, right? Which is your company. Hence it will be a PP for your own use, right? So if property is given on rent by parent to subsidiary, which is used by subsidiary as its head office, which means of office purpose, say, then the classification and financial statements of parent would be standalone financial statement for parent will be investment property. Consolidated financial statement will be PP. Understood? Doubts? Any doubts? No? Hmm? Yes, consolidated will be PP. Because in consolidation there's no individual companies. It's whole company one. So आपकी कंपनी ने आपकी कंपनी को लेट दिया and you're using it for your own use. Okay. Now let's say one more say X Limited has given this property on rent to Y Limited. Y Limited subsidiary. Y Limited again sublet it to Z Limited. Z Limited has no connection with Y Limited or Z Limited. Okay, it's an third party company. So it's an investment property for X Limited because it has given rent. For Y Limited, it's also an investment property, right? It has given on rent. For company as a whole, whether this property is used by anyone in company? No. CFS यानी as a group में किसने use किया property को? Anyone in the group has used this property? No. It's being used by outside third party, right? So it's a investment property for company. So parent के लिए investment property, subsidiary के लिए investment property because it has sublet it to third party. For CFS company as a whole, it's also an investment property. At the end, its end use is mandatory, right? Not immediate use. End use कौन कर रहा है? End use if you're using yourself, then it's a PP. If your end use is done by some others, then we'll check end use only. If some other party, then it's investment property. In case the entity's main business is to earn a composite rent income by providing the property on rent along with substantial other services, then the classification of property should be PP. So what they're saying basically, now in a hotel, do you just get room? You get many additional services like just say breakfast service, food service, spa service, many different services you get in hotel. So providing hotel room on rent is basically their business. That's business income, right? That's not say you are not saying that building मैंने जो खड़ी की है is not for investment purpose. It's my business purpose, right? So it won't appear as investment property in for the hotel, right? This building won't appear at investment property. So in case then, so what they're saying, if entity's main business is to earn composite rent income, composite means other than just not rent on property, but also it provides other services and it's charging for those services, right? Room cleaning services, many services hotel provide, right? Classification should be PP. Understood? Done. So now let's move on to sums. Okay, sum number one. Unlimited owns a building having 15 floors. So they have 15 floors, right, in a building, of which it uses 5 floors for its office purpose. So 5 floors are being used for own use, and hence it's a PP, right? The remaining 10 floors are leased out to tenants under operating lease. So these are leased out for operating lease. So they are earning rental income, right? So according to law, company could sell legal title to 10 floors while retaining legal title to other 5 floors. Advice on classification. So whether there are other 10 floors are separately saleable, 10 floors or other 10 floors are separately saleable, right? So 5 floors will be and 10 floors will be, right? First, we will give provision as per Ind As 40. Property which has dual use can proportionately be shown as PP in an investment property in case both parts are capable of being separately sold, right? If both parts cannot be separately sold, then entire property would be classified as PP. If the unless owner share is insignificant, right? So we have given now provision. Now we will link to the case. In this case, Sun Limited could sell legal title for first 5 floors and next 10 floors separately, right? Then hence carrying value attributable to first 5 floors would be PP and the remaining 10 floors will be investment property, right? Really easy question. Now let's move to next question. Moon Limited uses 35% of its office space of the building as its head office. So office floor space. So they have one floor. Uska 35% they are using for head office and leases out remaining 65% to tenants. So there's a floor out of which 35% they are using for own office purpose and 65% they are using giving it out as rent. But it is unable to sell the tenant space or entire finance leases related solely to it. So they cannot sell that particular 65% outside. They need to sell either completely as a whole or they cannot sell this half 60%. So advice on classification. So now classification will be PP, right? Because owner share is not insignificant and you cannot sell that part of 65%. So it will be classified as PP, right? So in the given case, the entire property is classified as PP. Next, question 3. An entity owns an hotel which included an health and fitness center housed in separate building that is part of premises of the entire hotel. Okay. So let's say there's a big hotel. Okay, so they have many buildings. So in one building they have spa service, which is health and fitness. Okay. So they have health and fitness center in one building, and one building they have rooms. Okay, all are in hotel premises only. So the owner operates the hotel and other facilities of the on hotel with the exception of health and fitness center. So they have health and fitness center they have given to someone else to operate, right? Which can be sold. The health and fitness center will be leased to an independent operator, right? The entity has no further involvement in health and fitness center. Advice on classification. Okay, so now they are asking as classification. They are asking what will be the classification. Hmm. Since because the hotel part is basically it's not an investment property, it will be shown as PPA, right? Spa and filter health and fitness center, they have completely leased out that building, right? They have no rights over this building. They have leased out it to someone else. They will receive rental income, right? So it will be an investment property. So starting will give a provision here, right? Next, in this case, hotel, building, and health and fitness center are capable of being separately sold. So you can separately sell, right? And hence, health and fitness center will be investment property, and hotel building will be classified as PP, right? Let's move on to next question. In financial year 2011-12, X Limited incurred falling expenditure in acquiring property. So they have incurred falling expenditure in acquiring property. There are six identical houses, each with separate legal title. So separate legal title means which can be sold separately as well, right? Including the land on which it is built, right? The expenditure incurred on various dates are given below. So purchase price of cost of property. So purchase cost is 1 crore 80 lakhs, right? Non-refundable taxes 20 lakhs. So will they be added? Non-refundable, they will be added because no credit is available. We have incurred actual cost and will be added, right? On April 2, legal cost related to property acquisition is 5 lakhs. On April 6, advertisement campaign to attract tenants is 3 lakhs. Whether these 5 lakhs will be added, these are related to acquisition and hence it will be added. Whether advertisement cost will be added, these advertisement costs are not related to acquisition. These are related to sale, which means operation, right? So this won't be added. It will be taken to P&L and expensed out, right? On April 8, opening ceremony function for starting business is 1,50,000. So opening ceremony function, whether it will be added? No, it will be ignored and taken to P&L and expensed out, right? Throughout 2011-12, incurred rupees 1 lakh towards day-to-day repairs and maintenance and other administrative expenses. So whether it will be added in cost of investment property or PP, P&L, because they are day-to-day maintenance expenses, they are of operating nature and hence it will goes to P&L, right? They are not related to acquisition of asset, right? Next, X Limited uses one of the six houses for office and accommodation of its few staff. The other five houses are rented to various independent third parties. How X Limited will account for all the above mentioned expenses in the books of account? Okay, so whether all six are investment property, whether all six are PP, or whether separate classification is done proportionately, what should be done? Proportionally, we can classify because we can sell each independently, right? So how many houses are PP and how many houses are investment property? So one house is PP and rest five which are given on rent are basically our investment property. So now first let's identify the cost. So total cost is 1 crore 80 plus 20 lakhs, which is basically 2 crores, 2 crores and 5 lakhs is added. So 2 crore 5 lakhs will be divided among 6, right? Proportionately. So 1 by 6 is basically PP. So your PP will be 34 lakhs 14,000, 16,000 and rest 5 are investment property. So investment property will be 1 crore 70 lakhs, right? Advertisement expenses, maintenance, inauguration will be taken to P&L, right? Any doubts? No, right? Let's move on to next question. Next question 5. Moon Limited. Moon Limited has purchased a building on 1st April 2011 at the cost of rupees 10 million. So basically, Moon Limited has purchased one building on 1st April 2011 at cost of 1 crore rupees, right? The building was used as a factory by the Moon Limited and was measured under cost model. Okay, so building was used by factory. So they have used building as factory, which is basically PP, and it's used under cost model, right? The expected useful life of the building is estimated to be 10 years. Due to decline in demand of the product, the company doesn't need the factory anymore and has rented out the building to a third party from 1st April 2015. So how many years? After how many years? So after 4 years, company has changed its classification, right? Whether they have actually given on rent or whether they have intended. They actually given on rent. Now we will reclassify it to investment property from PP, right? On this date, the fair value of building is rupees 80 lakhs, 8 billion. Why do you think this fair value is given? We'll take WDV, right? WDV of जो PP का WDV रहेगा after 4 years, we will just take it that value as our investment property value, right? Then why this fair value is given? Disclosure, right? We need to compulsory give a disclosure. Hence, this fair value is given. Moon Limited uses cost model for accounting of its investment property. So what? Which model Moon Limited uses for investment property? Are there any other option? No, only cost model, right? So what should be value recorded under Ind As 40? So what value should be recorded? Basically, 10 crores is the cost, right? 10 crore is the value of property. We'll have depreciation of for how many years? 4 years, right? Divided by 10 years is useful life and 4 year depreciation, right? So 400 lakh will be depreciation, right? So now carrying value will be 600 lakhs. So this is carrying value of PP. Same will be carrying value of investment property, right? Right. So 60 lakh will be carrying value of investment property as well, and we will disclose in notes that fair values, right? So therefore 6 million would be taken as carrying value of investment property. The fair value of 8 million would be separately disclosed in the notes. In exam, basically, if they are given values in million, you do in millions only, don't convert into lakhs, right? Next question 6. Netravati Limited purchased the commercial office space as an investment property. So they are directly given us that it is an investment property in the Global Trade Center commercial complex for rupees 5 crores. So acquisition cost is 5 crores. However, for purchasing the same, the company had to obtain a membership of the Global Trade Center Commercial Complex Association by paying rupees 6,25,000 as one-time joining fees. So what is this? This 6,25,000 is one-time joining fee. So if you don't pay this fee, can you purchase the building? No, right? It's compulsory. So it's easy to pass the acquisition. So will it be added? Yes. So it will be added. Right. Next, Netravati wants to write off the one-time joining fees as expense under membership. So can Netravati do this? Netravati wants to write off one-time joining fees as expense. So it cannot do it, right? And subscription charges and value the investment property at 5 crores. So advice. So what will your advice be? Yes. So as per Ind As 40, all the directly related expenses needs to be added capitalized and hence it cannot be expense to P&L, right? Would your answer change if the office space was purchased with the intention of using it as administrative center of company? Even then our answer will be same, but it will not be shown as investment property, it will be shown as PP, right? So writing of 6,25,000 to P&L is not appropriate, right? In case of investment property. If you use the administrative office, even in this, even under Ind AS 16, all direct costs are added, and hence cost of asset would be 5 crores 6,25,000. Right? Done. Let's move on to next question. Question number 7. Shoria Limited owns a building A, which is specifically used for the purpose of earning rentals. Right? So it is a investment property. The company has not been using the building A or any of its facility for its own use for a long time. Okay, we know it because it's an investment property. The company is also exploring the opportunities to sell the building if it gets the reasonable amount of consideration. The company is looking to sell the building. So whether it's non-current asset held for sale, whether the company wants to sell the property at any cost, or whether only if it get reasonable amount of consideration. So whether do you think so? If company doesn't get reasonable amount of consideration for 1 year, 2 year, whether company will sell it? No, right? Whether sale looks highly probable here? No. Just because you want to sale doesn't look highly probable, right? So whether it will be an investment property only or it will be a non-current asset held for sale. Investment property only, right? Following information is relevant for building A for the year ending 31st March 2012. Okay. Building A was purchased 6 years ago. यानी कब purchase किया? When did company purchase it? The 1st April 2006, right? At the cost of rupees 10 crores. So 10 crores is its cost. And building life is estimated to be 20 years. The company follows straight line method of depreciation. So what will be today's WDV? 10 crores minus 10 crore divided by 20 into 6, which basically will turn out to be 7 crores, right? WDV will be 7 crores as of today. During the year, the company has invested in another building B. So the company has brought another building B with the purpose to hold it for capital appreciation. Then this building B is also investment property, right? The property was purchased on 1st April 2011 at the cost of rupees 2 crores. So when did it purchase? How many years back did the company purchase building B? 1 year back, right? Expected life of building is 40 years. So what will be the carrying value now? 2 crores minus 2 crores divided by 40, right? Which will basically turn out to be, so basically it's 1 crore 95 lakhs, right? As usual, the company follows straight line method of depreciation. Further, during the year 2011-12, the company earned or incurred the following direct operating expenditure relating to building A and building B. So what have we given? ये सब क्या है? Operating expenditure, right? All these are operating expenditure. Operating expenditure anyway would be capitalized, right? These all will be taken to P&L only. So rental income, it's an income, it will be shown in P&L, other income, right? Sales promotion expenses, P&L. Fees and taxes. If at all we are given that is related to acquisition, then we would have capitalized it. But they have clearly given that these are operating expenditure. So they have to go to P&L. Ground rent, P&L. Repairs and maintenance, P&L. Everything will go to P&L, right? The company does not have any restriction and contractual obligations against property A and property B. For complying with requirements of Ind As, the management has sought an independent report from the specialist so as to ascertain the fair value of buildings A and building B. Right? They need to get building fair value, right? The independent valuer has fair valued the property as per valuation model recommended by International Valuation Standards Committee. So did management do right? Yes. Fair value has been computed by the method of streamlining present value of future cash flows, namely discounted cash flows method. So they have derived fair values by discounted cash flow method. So why are we given this part? We need to disclose techniques and assumption used, right? The other key inputs are estimated rent per month per square feet for the period is expected to be in the range of rupees 50 to 60, right? So this is per square feet rent. So why are we given this? Rent, we are already given rental income. Why are we given this? What are we required to disclose for investment property? Fair value. Fair value. We have fair value. We want to disclose, and what are the other two things which needs to be disclosed? Technique. Technique by which have we done valuation? Technique. This is the technique, right? We got the technique covered here, right? So this is the technique. And other thing is assumptions used. So assumption they have used this estimated rent will be 50-60, right? So this needs to also be disclosed. And further, what is the assumption? Expected to grow at 10%. Rent is expected to grow at 10% for 3 years. For every 3 years, rent will grow by 10%, and the weighted discount rate is 12 to 13%. So this is also their assumption, right? Assume that fair value of the property based on discounted cash flow method is measured at 10.5 crores. So 10.5 crore is fair value, right? So fair value, we got fair value. we got assumption, we got technique. Everything is covered here, right? Next, the treatment of fair value of properties is to be given in financials as per the requirement of Ind AS. What would be the treatment of building A and building B in the balance sheet of Shaurya Limited? So they're asking us treatment in balance sheet. How will we provide detailed disclosure and computation in line with relevant Ind AS? Treat it as if we are preparing a separate note or schedule of the given assets in the balance sheet. So what does they want? They want how would we prepare in the balance sheet, right? As a separate note, how would I we prepared? Right? So what is the opening value of gross block? What building did we have at year beginning? Building A or building B? Building A. Building A was purchased at up before 6 years at 10 crores. The gross block of building will be 10 crores. Depreciation for that building will be depreciation will be 5 years as at opening. Opening तो 5 years का depreciation रहेगा ना, year end पे 6 years complete हुए. So basically it will be 2.5 crores, right? Current year depreciation will be 0.5 crores, right? So closing will be 3 crores. Net opening will be 7.5 crores. 10 minus 2.5. Net closing will be 10 crores minus 3 crores, 7 crores. This is all for building A, right? This is all for building A. Now building B. Building B was purchased this year, right? Then was the building B purchased on 1st April 2011, right? We are doing for 31st March 2012, right? So purchase during the current year. Purchase at rupees 2 crores, right? There won't be opening. Closing will be 2 crores, right? Depreciation, opening depreciation. Will there be any opening depreciation? No, there won't be any opening depreciation, right? Current year depreciation is 0.05 crores. This is basically 5 lakhs. So closing will be 0.05 crores. Opening nothing. Closing will be 1.95 crores, right? Now in balance sheet, in the asset sides, in the non-current asset, we will disclose investment property, right? We will disclose investment property. In investment property also will have property A, this is building A and building B. Either we can disclose it in this way or we can directly write the investment uh, total amount, right? So now let's look at the answer, right? I want your attention here, right? In the balance sheet, an asset side, investment property will appear at 895. 895 is basically the net value. We'll record only net values in balance sheet, right? So opening, additions, closing, opening, additions, closing, and opening, closing for net, right? So this is investment property note. In addition, we'll give one notes to account also, right? Have they given? Yes, so they have given additional note also. The above fair value has been determined by independent valuer as per which method? Discounted cash flow method. recommended by I see the key input or are this, right? Assumptions also they have given it. But where did they give fair value? In notes to account they have given fair value, right? And under fair value they have given a specific note, right? Are we asked about data in P&L? They have asked us to give detailed disclosure and computations in line with relevant Ind As. So they are not specifically specified that they want only balance sheet item. They want detailed disclosure. So we'll give disclosure for P&L items as well. Other income will consist of rental income from both property, and all depreciation and other expenses will be recovered. What thing we will mess up is we won't record depreciation here. We will forget to write depreciation here because this is not given. We will forget. But actually we are computing here, and this amount will should appear here. So this may be your mistake spot. So just highlight it where you may make a mistake here, right? Just take 2 minutes to review the question. Okay, so let's move on to next question. Question number 8. An entity on 1st April 2019. An entity purchased an office block building for rupees 50 lakhs. So they have purchased a building and paid a non-refundable property transfer tax and direct labor cost of 2 lakh 50 and 50,000 respectively while acquiring the building. So what we will do with this both costs? 2 lakh 50 is refundable property transfer tax, right? The non-refundable. Will it be added? Yes, it will be added. And direct labor cost, this also will be added. Next, during 2019, the entity renovates the entire building into a two-story building. So they are renovating building and making the building into 2 floors. Expenditure on redevelopment were rupees 1 lakh building plan approval, rupees 10 lakh construction cost, out of which 60,000 is refundable purchase tax, and 40,000 was due to abnormal wastage of material and labor. Right? So whether this building approval cost needs to be added, are they subsequent expenditure? Yes, they are subsequent expenditure. They are renovating building, right? So whether these not cost needs to be capitalized, right? They are now necessary for the building to be get into the position required by the management, right? So it will be added. Construction cost, will it be added? So 10 lakh minus 67 will be net of refundable tax will be added, and 40,000 due to abnormal wastage and material. It will go taken to P&L. But the question still arises is whether this 40,000 are included in this 10 lakh or not, right? They didn't mention anything, right? We are not aware whether this 10,000, 40,000 is part of 10 lakhs or not, right? Most probably they should be part of this, right? Most probably assumption would be like they should be part. What they have done here, so they have not considered it, right? So any assumption we can follow, just we need to mention it, right? In the PP, remember they have subtracted it, right? But now they have done different treatment here, right? So when the redevelopment of building was completed on October 1, so building redevelopment got completed on October 1. The entity rents out ground floor of the building to its subsidiary under operating lease. So they have rented ground floor to subsidiary, right? In return for rental payment. The subsidiary uses the building as a retail outlet for its product. So subsidiary is making own use of it, right? It's not further letting it. The entity kept first floor for its own administration and maintenance staff usage. The first floor is for its entity's own use. The first floor is for holding company own use. Ground floor is for subsidiary's own use. Equal value can be attributed to each floor. So value of both building will be both floors are equal. How the entity will account for all the above mentioned expenses in the books of account. Also discuss how the above building will be shown in consolidated financial statement of entity as a group and its standalone financial statement as per relevant Ind As. Okay. So in relevant Ind As, as per relevant Ind As, standalone balance sheet of parent, whether it will be investment property, whether it will be PP or both, right? Because one floor it's using for investment purpose and one floor it's using for own use. So we'll have both values. CFS, CFS PP because overall it's own use only. And in subsidiary, it's PP, right? Ground floor C. Ground floor of SFS is investment property for parent. In case and for a group as a whole, it's PP and subsidiary, it's a ROU PP. Rent out, so ROU asset PP. First floor. The first floor of parent is PPE for parent, whether in standalone or consolidated, right? No matter. Understood? Why have we making differentiation here? Why have we not given directly for building as a whole? Because both are separately saleable, right? So you need to make compulsory you made distinction here. We'll add all these costs given in the question, right? And then we'll attribute it equally. So any complexity here? Yes, they didn't consider, but we need to give it, right? Add assumption here. You don't add assumption here. If I say doesn't give this way, in which way you have assumed, then you would lose marks, right? Next question 9. Let's move to question number 9. X Limited owned a land property whose future use was not determined. So X Limited has a land, it doesn't future use is not determined. Then what it shall be classified as PPE or investment property? Investment property because future use is undetermined. In this case, we'll record it as investment property. How should the property be classified in the books of X Limited at 31st March 2011? So it's basically investment property. During June 2011, X Limited commenced construction of office building on for its own use. Presuming the construction of the office building will still be in progress as of 31st March 2012. So as on 31st March 2012, whether it's an investment property or whether it's a PP, whether it's a PP or as an investment property. So it's a PP. So incorrect. Basically, what we have said, not just assumption needs to be changed, actual use needs to be changed. Property is still in under construction. So actual use changed. No, actual use didn't change. Right? Actual use will be changed when property is taken into consideration, right? So till then, it's an investment property only. Question number 1, how should the land property be classified in X Limited on 31st March 2012? Investment property. Will there be any change in carrying amount of property? No, right? Will there be any change in classification to or from investment property to changes is a change in accounting policy? Here actually construction began, right? Construction began. Work has begun basically. If construction was not begun and if they have assumed, then it will be a investment property. Since construction has begun, it will be now PP. Actual work has become actual usage now they have changed. See, after in this case there can be one complexity here. Let's say there was a land with undetermined use, right? They started building, still their use is undetermined, right? Afterwards, when building is under construction, so when building is under construction, they have decided that I will use it for office purpose. So in this case, whether it be PP or investment property, it will be investment property because when it was under construction, also building, they assumed it as they didn't have any use. They didn't assume any future use, right? Undetermined. But in this case, what happened is they had land which has future undetermined use. But before starting the building, they have assumed that I want to make a building for my office purposes, right? So when building construction start, actual usage is also starting, right? Understood the difference between both cases? Just say generally I have a land. Now on this land I have started construction of building with no assumption whether I will use it for investment or office. Then it will be investment property, right? When there's a land, then it's an investment property basically. Now I want to construct my building strictly for my office purpose. So when the construction starts, then my it will be converted into PP, right? Now in this way, let's say my half construction has done, right? Till half construction does, I have not determined what use I am doing, right? So from now on, I have decided for office, right? So till the building is getting ready, it will be investment property only. Understood? Because actual usage will start from because under construction it was investment property only, right? In this case, this is second type of case, right? And it will be PP, right? So whether there will be changing carrying value? No, right? Cost will be taken as cost. Again, अगर cost model follow करना है तो same ही होगा WDV. And if they are following revaluation model, revaluation will be taken from now on, right? Whether changes in classification to or from investment properties is a change in accounting policy. Whether it's a change in accounting policy or change in accounting estimate. So none of the both, right? It's change in facts now. Accounting policy, if change in accounting policy will follow retrospective accounting. Since it's not a change in accounting policy, will follow prospective accounting. What they have asked in question, whether it's changing accounting policy, then we'll write no, it's not a changing accounting policy, right? Would your answer to A be different if there was management intention to commence construction office building for own use? However, no construction activity was planned. So they had only intention changed. Actual work didn't start. Then it will be investment property, right? It won't be PP. So first we'll give provision. Basically, this is same as of theory book. Next we'll give it construction has started, building for its own use, and hence it will be investment to owner occupied construction because construction started, right? And carrying amount will still be same and will not change. No, the change in classification is not a change in due to change in user property, and no retrospective application is required. Mere management intention change is does not evidence change in use. So since there is no change in use, it will continue to be appear as investment property. Any doubts? Let's move on to next question. Question number 10. So beside manufacturing plants, A Limited has various other assets not used for operational activities. So A Limited has different assets which are not used for operational activities. So which means they are not used for own use, right? Example, freehold land, townships in different location, excess of office space rented to ABC, etc. Also, A Limited has some land which are kept vacant as per government regulations, which require the specified area around the plant should be kept vacant. Okay, so detail of assets. A limited office building. So whether it's PP or investment property, they are given that it's office building, right? A limited registered office in Delhi, of which only 3 floors are occupied by A limited, whereas the remaining floors are given on rent to other companies. These agreements are usually for a period of 3 years. According to A limited, such excess office space will continue to be let out on lease to the external parties and have no plans to occupy it in at least near future. So how many floors there are? 15 floors. 3 are used for own use and 12 are given out to let out. So 3 will be PP and 12 will be investment property, right? Next, flats in township located in location 1. So as regard to township in location 1, there are approximately 2000 flats in the said township. It was built primarily for A limited employees. Hence, approximately 80% of the flats are allotted to employees, right? So 80% is own use. Remaining flats are either kept vacant or given on rent to other external parties. Okay. So a lease agreement is signed between A limited and individual party for every 12 years. Okay, so they have signed lease agreement and being 1st April to 31st March. The lease entered is cancelable lease. Also, beside monthly rent, additional charges are levied by A limited on accounts of electricity, water, cable, connection, etc., which are basically they will all obviously every rented house will levy, right? According to A limited, there is no intention of selling such excess flats or allotting it to employees. So whether it will be PP or investment property, it depends, right? Basically, all flats can be separately sold, right? So when it has been allotted to employees, those are compulsorily PP, right? Which are compulsory, which those flats which are given on rent, those are compulsorily investment property. Those flats which are vacant, then we need to find their use, intended use. If they intend to give it to employee, then PP. They intend to give on rent, then if they don't intend anything, undetermined use, then investment property. Understood? So we need to completely. They didn't give us. See, in A they have given us clarity, right? In B thing they didn't give us any clarity, right? And hence we will answer accordingly. We will answer exclusive answer, right? Inclusive answer. Next, flats in towns located in location 2. Flats in township located in location 2. So there are 1000 flats. 400 flats are given to employees for their own accommodation. So 400 flats are 350 flats are given on rent to central government and state government employees for accommodation of their employees. Average lease period being 12 months with cancelable clause. So 350 flats are investment property. 250 flats are kept vacant. Then these are based on their intended usage, right? Hostel located in location 1. 60 rooms in hostel have been let out to G Limited to give accommodation to their personnel. Then these 60 rooms are right. Lease agreement is prepared for every 11 months and renewed thereafter. Besides the monthly rent, other basic things are charged, right? Understood? Land in location 1. In 2014, A Limited purchased a plot of land outskirts of major city. The area has mainly low cost public housing and very limited public transport facilities. The government has plans to develop the area as an industrial park in 5 years' time, and the land is expected to generally appreciate the value. So, why did we purchase land? For capital appreciation purpose. Hence, it will be A Limited has not decided what to do with the property. So, they have not decided whether they want to construct office or not in other properties. So, then it will be right. Land in location 1. A portion of land has been leased out to C Limited for its manufacturing operation. Land has been given on lease above for rental. So they have given portion of land for rental. Basically, it will be Investment property. A portion of land has been given on rent to D Limited, which has constructed a petrol pump on such land. It has been leased for a period of 40 years and renewed for further period of 40 years. Investment property. Say it was a building, then it will be देखो, land has unlimited life, right? So land has unlimited life. So in this case, lessor even gives for 40 years or plus 40 years, 80 years. Still, land will not be a finance lease for the lessor. But building doesn't have unlimited life. So building life is 80 years and you have given rent for 80 years, right? Then it's complete finance lease. And you need to de-record the asset, right? De-recognize the asset. So in this case, anyways, it's land. So no problem, right? So in both cases, it's land only, right? In this case, it is PP, right? It is both, right? Investment property as well as owner occupied portion, right? Second, flats in town ownership. With regard to flats kept vacant, evaluate the purpose of holding flats. So we'll check the purpose. Same goes with all these, right? Next question number 11. So we're left with question 11, question 12, 13, 14. So 11, 12, 13, 14. So we're left with 4 more questions. So Mr. X is a financial controller of ABC Limited. So basically, Mr. X is a financial controller of ABC Limited, a listed entity which prepares CFS in accordance with Ind As. Okay, so ABC prepares CFS, right? Mr. X has recently produced the final draft of financial statements of ABC Limited for year ended 31st March 2018 to Managing Director Mr. Y for approval. Mr. Y, who is not an accountant, had raised the following query from Mr. X after going through draft financial statements. Okay, so Mr. Y has raised some query. So let's solve these queries. The notes of finance statement said that plant and equipment is held under cost model. So is it correct? Can they hold plant and equipment under cost model? Yes, they can hold. However, property which is owner occupied is revalued annually to fair value. So what they're saying, first there is plant and equipment. So basically there is a first plant and equipment which is measured on cost model. Second, there's a property which is measured on revaluation model, right? Changes in fair value are sometimes reported to P&L and sometimes reported to other comprehensive income. So changes sometimes go to P&L and sometimes it's going to OCI. Also, the amount of depreciation charge on plant and equipment as a percentage of its carrying value amount is much higher than owner occupied property. It may be different because of life, right? And revaluation also. Another note says that property owned by ABC Limited but rent out to others is depreciated annually and not fair valued. So which means property rent out to others is basically investment property, right? They are following cost model and it's not fair valued. So it's obviously it's also right. Mr. Y is of opinion that there is no consistent treatment of PPA items in the accounts. How should the finance controller respond to the query from the managing director? So what they are saying that either follow everyone cost model or either follow revaluation model. It's not consistent, they are saying. So is it right? So PP, plant and equipment and property, both are different class of assets. So both can follow different method. One can follow cost model and one can follow revaluation method. And when it comes to P&L and OCI, so when if at all it is downward revaluation, it will go to P&L. If at all it is upward revaluation, it will go to OCI, right? Understood? And investment property, it will obviously be at cost only. Just because this property is valued at revaluation model, you cannot force this property to follow value cash model, cost model, right? You need, Just because this property is following revaluation model, does this have any compulsion to follow this property under revaluation? No, because it's not a PP, right? If at all it was a PP and both has similar end use, then both needs to follow same, right? But it is investment property, different end use, different nature, right? And hence it is can follow different method, right? So these all generally we can first we need to give provision and then we can give in our own way answer, right? We just need to have understanding about the concepts, right? Easily you can answer it, right? Can we move on to next question? Just refer after class. Just refer answer of this question. Refer these two. Right. Question 12. X Limited purchased a building for rupees 30 lakhs. So X Limited purchased a building for rupees 30 lakh on 1st May 2011 with an intention to earn rentals. So X Limited purchased building with an intention to earn rentals. So building is investment property. The purchase price was funded by a loan. Interest on which payable is 5%. Property transfer taxes and direct legal taxes of 1 lakh and 20,000 respectively were incurred. So these will be because they are incurred in acquiring the building. So they will be added, right? X Limited redeveloped the building into retail shops for rent under operating lease to independent third parties. Expenditure on redevelopment were 2 lakh planning commission, 7 lakh construction cost, including 40,000 refundable tax. So will these two values be added? 2 lakhs and 6 lakh 60 will be added because they are redevelopment expenses and they need to be capitalized, right? So what is the cost of building? 30 lakhs plus 1 lakh plus 20,000 plus 2 lakhs plus 6 lakh 60, right? 39 lakh 80,000. Why have you not considered borrowing cost? Because it's a purchase building, right? It didn't take any substantial period of time to get ready. Understood? So basically, fairly easy question. So if they have given qualifying asset, then we would have added it, right? They have didn't mention anything. Done. Easy question. Let's move on to question 13. X Limited purchased the land worth rupees 1 crore. It has a option to either pay full amount at the time of purchase or pay it over 2 years for a total cost of 1 crore 20 lakhs. What should be the cost of building under both payment method? So if it is opted to pay 1 crore, cost will be, so if it has opted to pay 1 crore 20, cost will be, still it will be 1 crore because it's a case of deferred payment and cash price, it will record cash price. Since cash price is given 1 crore, we will record 1 crore. In case cash price was not given, then we would have discounted 1 crore 20 to present value, right? Oh, let's move on to the last question. Question number 14. This is an important question. Right. Special Limited is a multinational entity that owns three properties. Okay, I want your complete attention. So Special Limited has three properties. Property 1, Property 2, Property 3. All the three properties were purchased on 1st April 2020. So they purchased properties on 1st April 2020. The following details are furnished. Purchase price is given 7 lakh 50, 10 lakh 50 and 12 lakhs. All have different lives 10, 15, 15. And fair value is also given. So why do you think fair value is given? Just to express in notes to account, right? Even if they are following fair devaluation, then we need fair value, right? Company uses property 1 and 2 for business purposes. So property 1 and 2 are PP, business purposes, right? The company is exploring the opportunity to sell property 3 if it gets reasonable consideration. Now it's a Non-current asset held for sale, right? No, right? Because we are not used whether sale is highly probable or not. Till the time it is not sold and it has rented the property. So it's an investment property, right? It has adopted revaluation model for subsequent measurement of these properties. So then can company do it? For property 1 and property 2, it's okay. But property 3, it cannot do it, right? So it done wrong treatment for property 3. The depreciation is charged on straight line method. So we need to depreciate all three properties or only 1 and 2? All three we need to depreciate, right? So this is correct. Okay. However, the company has not charged any depreciation on property 1 and property 3 on the current year since the fair value of properties exceeds carrying amount. So property 1 and 3 has more value more than carrying amount. Sorry, carrying value is more than fair value. So WD is more than fair value. So they have not depreciated it. Is it correct? No. But let's say they are following revaluation model, right? So if at all even they have depreciated, they would have got same amount, right? Carrying WDV after revaluation, WDV would have been same. Then not doing depreciation won't work. So depreciation is compulsory, but if either if you're following cost model or revaluation model, right? So this is an incorrect treatment. Okay. The difference between fair value and carrying amount has been recognized in statement of P&L. So difference between fair value and carrying amount. So they have taken to P&L. So is it right? So is it right? Okay. So if at all there is a upward revaluation, you need to take to revaluation surplus. And in downward revaluation, you need to take to P&L, right? The properties are shown under the head PPE in balance sheet. So is it right? No, only one, two are PP, and other rest one is investment property, right? Analyze and whether the accounting policies adopted by the company in relation to the given properties are in accordance with Ind As. So are they are according to Ind As? No, right? If not, advise the correct treatment and present an extract of balance sheet for year ended 31st March 2021. So they are not as per Ind As, right? We need to give correct treatment. So what will be the correct treatment? Question number 14. Property 1, property 2, and property 3. So property 1 purchase price is 7.5 lakhs, 10.5 and 12. Useful life is 10, 15 and 15. So all follow straight line method and only 1 year has completed, right? So we'll depreciate for 1 year. Basically opening minus depreciation. Depreciation will be 75,000. 75,000 which basically 7.5 divided by 10. In this case depreciation will be 10.5 divided by 15 which is 70,000. And in this case 12 lakh divided by 15, 80,000, right? So we'll have carrying value WDV 6 lakh 75, 9 lakhs 80,000 and 11 lakhs 20,000, right? Next, property 3 is investment property and we will leave here, right? We won't follow revaluation model for property 3, right? In case of property 1 and 2, we will check for revaluation, right? So property 1 fair value is 8 lakhs. So we'll have upward revaluation, right? Upward revaluation. It will go to OCI, right? How much? 1 lakh 25,000, right? 8 lakh is the fair value. So WDV after revaluation is 8 lakhs. And in this case, 9.5 lakhs. So we have a downward revaluation, right? Downward revaluation will goes to P&L. How much? 30,000, right? It will, we have a carrying value of 9 lakh 50,000 and it has 1 lakh 11 lakh 20,000, right? Done. How will it appear in balance sheet? In balance sheet, under the head assets, we have non-current assets. Under non-current asset, we have PP. So under PP, property 1 and property 2 will appear as at 8 lakh and 9.5 lakh. And in investment property, we'll have property 3 at 11.2 lakhs. Other than that, we'll give a note on in fair value for investment property, right? In notes to account. Done. Understood. So we have same 8 lakh, 9 lakh 50 and 11 lakh 20. 8 lakh, 9 lakh 50 and 11 lakh 20. It will appear in balance sheet, right? We have given extract. Revaluation reserve needs to be given as well, right? There's revaluation reserve balance, right? You need to give that balance as well. We are not have been asked about P&L extraction, right? They've asked for balance sheet extract only. So we will the mistake which we make here is we may forget this. Okay. So the mistake which we make here is we may forget this. So just highlight this, right? Rest all basically they are explaining the mistakes which they have done, right? First we need to explain the mistakes done. The property 1 and 2 should be PP, but property 3 should be investment property. Revaluation model is permitted only in case of PP, but not in investment property. Next, depreciation needs to be recorded for all, right? Whether or not your carrying value is higher or lower. And in this order, there is no revaluation, right? Initial upward revaluation will be taken to OCI and initial downward will go to P&L, right? Done. So we're done with this chapter. Any doubts? No? So let's stop for a 10 minutes well-deserved break. Then we will continue the next chapter, Ind As 36, right? So let's stop for a break. Okay. So now let's start with the new chapter, Ind As 36, impairment. Before just coming to this chapter, we have heard much about this chapter, right? So what's impairment? So when recoverable value is less than carrying value, that's impairment. Okay. The impairment in general terms, basically, uh, so impairment in general terms means when asset get impaired means when the asset capacity reduce, earning capacity of the asset get decrease. It's basically then we say that asset is impaired. Okay. So basically, impairment in literal terms means indicates a reduction in earning capacity of the asset. So theoretically, impairment means reduction in earning capacity of the asset, right? From our sums perspective, it is when carrying value exceeds recoverable value, right? When carrying value exceeds your recoverable value, then we need to check for impairment, right? Generally, when do we check for impairment? So when there are certain conditions exist, then only we'll check carrying value and recoverable value. Other than that, we won't check, right? So let's discuss about the conditions. Let's discuss when impairment needs to be checked. For certain three assets, which I have mentioned to you before, that we need to check annually, right? Intangible assets and which are under development, intangibles with indefinite life, and goodwill and business combination, right? For these three assets, goodwill, intangible with indefinite life, and goodwill, intangible under development, we'll check every year annually, right? And other than those, we'll check when indicators exist, right? Now, what's the logic behind this, right? What's the logic behind this? Why these three are checked annually? What's the logic? What do you think? All assets value will ultimately be zero on any one day, right? At the last, all assets value will be zero. But will goodwill be zero? No. Goodwill doesn't have any depreciation, so goodwill will never be zero. Will intangibles with indefinite life will be zero? They don't have any amortization, right? So they will never be zero. And intangible under development. So will amortization will be done to intangibles under development? No. When intangible is ready to use, we will start amortization. So till then intangible will never be zero. So these assets have no cannot be zero. Hence we need to check for annual impairment, right? Baki for different assets, even if you don't check for impairment, say they are impaired, but you didn't check and didn't impair them, eventually they will turn to be zero. But these assets eventually won't go to zero. You need to check annually, right? Understood? Understood the logic why we are doing this? Common between 1 to 3 is basically they all lacks physical substance and nothing has no amortization, right? So all doesn't have physical substance and no amortization. So what are the indicators when we check impairment? What are those basically indicators? The external indicators, adverse technological changes. So you are using a machinery, right? So you expect that machinery will work for 10 years, right? But after 2 years, they let's say they launched a different machine in the market. Okay, so because of that machine, now let's say there was a machine, okay? You purchase the machine. Now machine value is 5 lakhs, okay? So because of now they launched another machine. Instead of machine, let's use a phone. That would be okay. There's a phone basically, okay? You, previously Nokia phones, keypad phones used to be value of say 5,000 rupees. You used to get one phone, okay? Now in smartphone, if you get smartphone for 4,000 rupees, why would any person purchase this keypad phone, right? Right? Okay. So you purchase this on 1st April 2010. Let's say you purchased at that time you purchased a keypad phone. Now till now, then touchscreen smartphone were around 15,000 rupees. Okay. But due to technological changes, now now smartphones have price have reduced to 4,000 rupees, right? So if new smartphone value is 4,000 rupees, so what do you think old keypad value would have drastically reduced, right? दो साल में कितना depreciate हुआ होगा, even if you take like 5 years, right? The 5,000 would have depreciated to 3,000, but would it yield 3,000, right? It won't yield 3,000, right? Smartphone, because new touchscreen smartphone value is 4,000, right? Then in this case, maybe new keypad phone would be 3,000, but it is 2 years old, right? So because of adverse technological changes, there may be chance that asset value have been degraded. Then you need to check for impairment. Understood the logic? Next, legal prohibition. Say you have a diesel car, okay? Say you have a diesel car. You have purchased diesel car. Say after 2 years, government has banned production of diesel cars. The value of diesel cars would take a hit, right? Because now diesel car, no one will purchase it. So your diesel car value got hit. So then you need to check for impairment whether will I recover that value or not. Now we'll calculate recoverable value of that car. Okay. then it will check for impairment of those because of legal conditions, legal prohibitions. The car got banned, diesel car, because it's making so much pollution. Government banned diesel car production. So they will take a hit. Then in this case, we need to check for impairment. Next, entry of a strong competitor. Best classic example is Geosentry. Geosentry, all other mobile brands except for Airtel, they got a major hit, right? Airtel also got a major hit, but it took its stance. It got itself handled. But what about Vodafone, Idea, Aircel, Uninor? We have many brands, right? They all got a big hit because of Geosentry. So then you need to check impairment because now license of are no use for them because they are unable to run in the market, right? Next, market capitalization is less than book value. So your market value is less than book value. Say you are listed company. Book value per share is 1 rupees, but in the market your share is being traded at only 0.5. Why is this? Maybe they are expecting some drastic to happen to this company. So in this case also you need to check your for impairment. Adverse, see market capitalization, market will be based on actual values. से market को दिख जाता है कि भाई ये machinery तो ये 100 में बता रहा book में. He is showing this machinery at 100 and hence his book value per share is more. But actual the machinery value is only 20. Accordingly, market value already changed it. Your book value remains same. Market will be on actual values. It won't work on book values, right? So now if you can see that happening, then just check your book values. Are your book values correct? Because market value never goes beyond your book value, right? Adverse effect due to lockdown. So due to extended lockdown, maybe assets got impaired, right? Say water came when your factory was closed, water came. Now your machine value got degraded. Machine cannot produce as much unit, so benefit from machine decreased, right? Internal, those are external. Internal indicators of physical damage to asset, flood, say flood, which we have discussed now, right? Continued cash losses. So you are not making any profit. Moreover, you are making loss, but these are also cash loss. So you are not recovering total value, right? Because in this, these are some of the indicators. These are not complete list. These are some major. Other than that, there are many indicators which can need this can need the impairment, right? For our exam perspective, we are not required to remember all this, right? We just in the question if they give recoverable value, we need to assume indicator have existed and we'll calculate impairment, right? Even if they don't give, we'll calculate because ये तो practical perspective में we need to check, right? In, so now who will decide whether indicator exists or not? So management has sole discretion. If management feel that indicator exists, the management will do for impairment, otherwise it won't do, right? So basically impairment is basically comparing of carrying value with recoverable value. So basically it's comparing of carrying value with recoverable value. Carrying value is basically ledger balance. The balance is WDV, right? Carrying value means generally ledger balance WDV, cost minus depreciation. Recoverable value. So what is this recoverable value? It's basically higher of net selling price or value in use. Right? Say you have purchased a car for 100 rupees. Okay. Now you have depreciated it. Now WDV say 10 years is its life. You have depreciated for 2 years. Now car WDV is 80. Now if you sell that car today, okay, if you sell that car today, you would get say 70 rupees. Okay, you will get 70 rupees. Say for selling, you need to incur some expenses, cost to sell, say 5 rupees. So you can sell the car today for 55 rupees, right? So do you think car is impaired? If you sell, you get only 65, but in your books you are showing 80. So do you think car is impaired? Yes, but it's incorrect. Car may or may not be impaired. Why? Because did you purchase car for selling or for using? So we need to check value in use also. But because of using, how much value we are getting, right? So value in use कितना है? Say by using this car, I'm making a savings of traveling cost of 100 rupees per annum. Oh, sorry, 100 rupees would be more. Say hypothetically, I'm saving 10 rupees per annum. Okay, or let's say 20 rupees per annum. I'm saving it. How much I'm saving? 20 rupees per annum, right? How many years are left? Life 8 years is left. So 8 years I'll say how many rupees? 160 rupees. I'll say 160 rupees traveling cost. Say if at all there was no present values calculation. So what will be the value of car? If I use my car value will be what car value which I will get is 160. If I sell it today, my value which I'll get is 65. So whether there's an impairment or not? No. You are saying no. Why? Because value in use is more than carrying value, right? So you are saying it's not impaired, right? Okay. So let's say hypothetically it was not 160 and only 60. Then okay, you are saying impaired. Then impaired by how much? Impaired by 15 or impaired by 20? Whether we should do 80 minus 15 which is 65 or 80 minus 20 60. 80 minus 20 60 I should do. Say I am a logical man. I want देख आज मेरे को देखना है ठीक है मैं अगर कार यूज कर रहा हूँ तो मेरे को कितना बेनिफिट मिल रहा है 60 का बेनिफिट मिल रहा है ठीक है 60 का बेनिफिट मिलेगा लेकिन अगर मैं कार बेच देता हूँ तो मेरे को कितना बेनिफिट मिलेगा 65 का तो ज्यादा बेनिफिट किस में मिलेगा 65 में तो मैं कार ही बेच दूंगा राइट व्हाई वुड आई यूज इट दिस कार अंडरस्टूड so then we'll take this value right so can I say that we are taking higher of fair value minus cost to sell or value in use can I say that I am using taking higher of this value to compare with this WDV right so carrying value is so what is basically recoverable value so can I say recoverable value is higher of fair value minus cost to sell or value in use right and if at all my carrying value is greater than recoverable value only then I'll do impairment right if my carrying value is less than recoverable value which in this case is what is the recoverable value in this case 160 wala case my recoverable value is greater than 160 or 65 which is 160 so my recoverable value is greater than carrying value so in this case will I impair no right there is no impairment right so will I increase my asset 80 to 160 no so impairment is only reduction in asset so impairment doesn't mean increase right this is not revaluation right impairment is generally reduction okay so there will be no change right there will be no change understood let's come back to theory so we'll test for impairment impairment testing is basically comparing of carrying value with recoverable value so what is recoverable value higher of net selling price or value in use net selling price means fair value minus cost to sell value in use means present value of future cash inflows understood clear carrying value is basically ledger balance so understood why we are doing impairment how we do impairment reasons for impairment when we do impairment when we do impairment checking right impairment loss refers to reduction in carrying value so there is only reduction there won't be increase in carrying value impairment loss is basically carrying value minus recovery value only if it's positive negative means recovery value is high then we won't impair nor we increase right then treatment of impairment loss So what will do with impairment loss? Say now I was following cost model, so this is right? Now let's say I'm following revaluation model. I'm following revaluation model. Okay. So my WDV is 120. Okay. Because my revaluation surplus is, can I say 40? Right? How 40? It should be 120 minus 100, right? It's basically fair value is of 120. So I will increase my asset by 40, right? And my revaluation surplus will be 40. Okay. Now let's say my value in use was only 60. So there's an impairment, right? There's an impairment. What is recoverable value? Higher of this both, right? What is higher of this both? 65. So my recoverable value is, comparison between 65 and 60 is basically 65, right? So now there's an impairment of how many rupees? Is it impairment of 120 minus 65 or 100 minus 65 or 80 minus 65? Impairment value will derive by 120 minus 65 or 100 minus 65 or 80 minus 65. 120 minus 65 because the PP balance is 120, right? So impairment is how much? 55 rupees. Now this 55 rupees, where will 55 rupees go? Hmm. So according to you, it needs 40 needs to go to revaluation surplus, and next 15 should go to P&L, right? So obviously, because asset value has decreased, how can you show revaluation surplus? Revaluation surplus is when asset value is high. There is no asset value is already decreased. So first effect will go to revaluation surplus, and rest, if any, will go to P&L, right? So basically, in case there is existing revaluation surplus balance, then impairment loss should be first written off against revaluation surplus. Excess loss, if any, will go against P&L, right? Have you studied this somewhere else before now? 40. What have you studied in Ind As? Hmm? 16. What have you studied? Just in this class, we have actually studied, say, in case of reclassification, when we are reclassifying from co- PPE to investment property or investment property to PPE, right? So if at all there is a first we'll have if at all there's a if we are reducing, right, we'll first give effect to revaluation surplus, because if at all see PPE is following revaluation model, we are taking it to investment property cost model. So first we'll take net value, we'll adjust revaluation surplus and we'll take it, right? Okay. So impairment treatment is similar to downward revaluation. Same. Downward revaluation also we do same. First we take to revaluation surplus, and then if any we'll take to P&L. However, impairment will apply whenever indicator exists for asset under cost revaluation model. Downward revaluation is irrespective of indicators. So downward revaluation we do every 3 to 5 years, in case non-volatile, and volatile every year. But impairment will be done only when indicator exists, right? So impairment and downward revaluation treatment is same, but they both are not same. Understood? Treatment is same, but both are not same. Impairment loss can be recorded only till the time carrying value of the asset becomes nil, right? If asset carrying value is zero, how will record impairment loss? Value in ही asset का. Any loss beyond that will not be covered under Ind As 36. Instead, we should determine whether a provision is needed or a disclosure should be given as per Ind As 37 provisions and contingency. So what basically can happen is, say you are using a machinery. Okay, so you have used machinery for 10 years, machinery life is 10 years, now machinery value has become zero, but still you are using that machinery. Because of that, now using machinery, pollution got increased, so your machinery is releasing harmful gases. So government have ordered you to pay, say, you need to do restoration of site because of that harmful gas site got damaged, so government has ordered you to restore the site. Now you cannot add that 30 rupees to again PP. What you will do is basically you will create a provision for it. Right? Done. So now let's do the questions. Volume 1. Impairment of assets. Right? Find out the details of an asset. Find out impairment loss. So they are asking us impairment loss, treatment of impairment loss, and current year depreciation. So what is the cost of asset? 56 lakhs. Its life is 10 years. Current carrying value is 27.3 lakh is carrying value. Okay. So recoverable value is 12 lakhs. So they are directly given as recoverable value. So 12 lakhs is recoverable value. So do we have impairment? The impairment is 27.3 minus 12, right? Which is basically 15.3, right? Next, treatment of impairment loss. So 15.3 will, the 14 will be adjusted against revaluation reserve, and 1.3 will go to next current year depreciation. What is the value now? Asset values after impairment asset value will be 12 because impairment is 15.3. 27 minus 50.3 will be 12. Remaining life is 3 years. 12 divided by 3 is 4, right? Impairment loss 15.3. 14 will go to 1.3 and 4 will be depreciation. Done. Okay, question 2. On 1 January year 1, basically on January 1 year 1, entity Q purchased a machine costing 2,40,000 with an estimated useful life of 20 years. So machine useful life is 20 years. Cost is 2,40,000. Residual value is 0. Depreciation straight line. Asset has been revalued on 1 January year 3. So after 2 years to 2,50,000, but with no change in useful life at the date. On 1 January to year 4, after one more year, impairment review was showed that machine recoverable amount to be 1 lakh and estimated remaining useful life to be 10 years. Understood? So what they are asking, carrying amount of machinery on year 2 end and revaluation surplus arising on the next day, year 3 starting. Okay. So what is carrying amount? 2.4 lakhs minus 2.4 lakh divided by 20 into 2, right? Which is basically 2.4 minus 2.16 lakhs carrying value, right? And the fair value is 2 lakh 50. So we'll revalue, upward revaluation is 34,000. The revaluation surplus arising is 34,000. Carrying value is 2.16 lakhs. So 2.16 lakhs is carrying value and 34,000 is revaluation, basically 2 lakh 50,000, right? Carrying amount of machine on 31 December year 3 immediately before impairment. So they are asking us carrying amount year 3 end. So we have 2.5 lakhs minus 2.5 lakhs divided by 20 because there is no change in life. But 2.5 lakh is WDV. 2.5 lakh is WDV. We shouldn't take full year, right? Let's take remaining life. Remaining life is 18 years, which will turn out to be hmm? So 13,000 triple eight is depreciation. Then we'll come back to carrying value is 2,36,000 triple one, right? And if at all you miss it, write down here 2.5 lakhs divided by 18 years. Okay. Next, the impairment loss recognized in the year to 31 December year 4 and its treatment thereon. So the impairment loss recognized in the year. So how much will be the impairment loss? What is the carrying value? 2,36,111. What is recoverable value? 1 lakh. So impairment loss is basically 1,36,111. What they're asking impairment loss recognized 1,36,111. How will its treatment be? Revaluation register plus 34,000. Rest 1,02,111 will go to P&L. The depreciation charge for 31 December year 4. The depreciation will be after all these 1 lakh divided by estimated remaining useful life is now 10 years. So 1 lakh divided by 10 is basically 10,000. Right? Any doubts? No? Ready? So question 3. An asset does not meet the requirement of environment laws which has been recently enacted. The asset does not meet the environment law. And the asset is destroyed as per the law. Okay. The asset is carried in the balance sheet at year end 6 lakhs. So why have these two be given? Indicator for impairment, right? So the estimated cost of destroying the asset is 70,000. How is the asset to be accounted for? How much is the impairment? Hmm? 6 lakhs is book value. What is recoverable value? Recoverable value is minus 70,000. First of all, we need to destroy the asset. We won't get any rupees. Moreover, we need to we need to pay 70,000, which is the cost of destroying the asset. So how much will we impair? Will we impair 6 lakh 70,000 or 6 lakhs? Impairment can be till the asset is nil. The asset will be nil when we impair 6 lakhs. So impairment cost will be 6 lakhs, right? Impairment is 6 lakhs and provision will be created for 70,000 rupees, right? You have studied it, right? Ind As 36 impairment refers to reduction in carrying value of the asset. The asset needs to be destroyed as per law. Hence, it will neither be sold nor be used. Therefore, recovery value will be nil, right? Hence, the asset should be fully written off and impairment loss of 6 lakhs should be recorded in P&L. Additionally, the law has been enacted, hence the obligating event for incurring destruction costs has occurred. Hence, expense of 70,000 should be recorded along with corresponding provision as per Ind As 37 provisions and conditions. Right? Provision should be recorded for 37,000. 70,000, sorry. Okay. Okay, let's do this some last sum for this class. It's an important sum. Okay. PQR Limited is a company which has performed well in the past, but one of its major assets and equipment suffered a significant and unexpected deterioration in performance. So, indicator for impairment. Management expects to use the machine for further 4 years. So, life left is 4 years more, right? After 31st March 2016. So, after 16, they are still expecting to use for 4 years, but at reduced rate level. Okay. So, the equipment will be scrapped after 4 years. So after 4 years, equipment will be scrapped. So, there won't be any residual value. The financial accountant for PQR Limited produce a set of cash flow projection for the equipment for the next 4 years. So they have given us cash flow projection. So what would this will be used for? Calculating value in use for recoverable value, right? Ranging from optimistic to pessimistic. CFA thought that the projections were too conservative and he intended to use highest figure. Therefore, these are as follows. So CFO gave this figure, right? So will we follow CFO figures or financial accountant figures? CFO is big or financial accountant is bigger, right? So since CFO gave this figure, we'll follow this figure, right? So 276, 192, 120. So will we add this to calculate value in use directly? Yes. Are all these cash flows occurring on the same year or different years? Different years. So will we add it simply? We'll take it to present value and add it, right? We cannot add it simply, right? So what we need to find out to calculate present value? Discount it, right? So they have given us pre-tax discount rate of 9%. So whether it should be pre-tax or post-tax, that we will discuss in the future. So here we have not given tax rate. So basically we'll take 9% and calculate value in use, right? The machine could have been sold at 31st March 2016 for 6 lakhs. So 31st March 2016 is today's date. Today we can sell it for 6 lakhs, and related selling expenses in this regard could be 96,000. So 5 lakh 4,000 is net selling price. We need to calculate recoverable value. Then we can get, we need to calculate value in use. Then we'll get recoverable value. Then we can compare with carrying value, and then we'll get impairment, right? The machine had been revalued previously. So machine is following revaluation model. And 31st March 2016, amount of 36,000 was held in revaluation surplus. The revaluation surplus balance is 1,000. Are we given anywhere carrying value? No. Yeah, till now we had nothing is given, right? So the carrying value of the asset is 6 lakhs 60. Okay. The Indian government has indicated that it may compensate the company for any loss in value of assets up to its recoverable amount. Okay. The calculate impairment loss, if any, and revise depreciation of the asset also suggests how impairment loss, if any, would set off and how compensation from government would be accounted for. Okay. So pretty. What will generally do? 2,76,000, 1,92,000, 1,20,000, 1,40,000. Will discount it present value factor at 9%, right? Year 1, year 2, year 3, year 4. Can you help me with the present values? 0.9174, 0.8416, 0.7721, 0.7084, right? Then we'll get discounted cash flows, present value of cash flows, right? What are these cash flows? 2,76,000 into 0.9174, 2,53,202, 1,61,587, 92,652, and 8,750. We'll add this all and we'll get value in use, right? Which basically is 588,231, 588,231, right? So here 161,606. You might have mistaken, right? This may be due to rounding off. They have taken 8417 here. So anything, right? So we will calculate value in use first, right? We got value in use. Now we'll calculate recoverable value, which is basically higher of 6 lakhs. Okay, just don't go. Just understand the logic. Maybe this might not be accurate, right? So value is right. 7, it's 7722, right? It's 7722 into 1,20,000, right? And into 664. It is right, right? Only printing mistake, right? So everything is right here. Okay. Just a rounding off mistake. It's okay. Just remember to mention 4 decimals, right? And then do it. Next. Now we'll calculate recoverable value. We will know 5,04,000 is net selling price. Value is 588. So recoverable value will be higher, which is 5 lakh. 280. Okay, now carrying value of the asset is 6 lakh 60. So we have impairment, basically 6 lakh 60 minus 588, which is 71 770. Revised surplus balance is 36,000. So 36,000 will be adjusted to, so the revised surplus will go to 36,000, right? And the rest will go to 34,770 shall go to P&L. So 36 will be adjusted against revaluation surplus, 35 will go to P&L. And what they've asked, also suggested how impairment loss would be set off, which you have suggested. They ask revised depreciation as well. Revised depreciation is basically carrying value divided by estimated life left, which is 4 years are left, right? Next 4 years. So 4 years are left. So carrying value is 5 tablet 230 divided by 4, which is basically, yes, the depreciation is basically 1,47,057. Okay. And next they're asking how compensation from government should be accounted for. So what information did they give about compensation for government? The Indian government has indicated that it may compensate for a company for any loss in value of the asset. So it's may. So Indian government is not under obligation to compensate. It may compensate, right? So for any loss up to recall value, it will compensate. So since it have indicated it, will record it as a contingent asset, right? If at all it was given that government has accepted to give, then we'll record it as receivable. Since government has not accepted, it will be given an indication that it may compensate, hence we'll record a contingent asset. So any compensation from government would be accounted only when it becomes receivable. So it is not receivable. At this point, the government has merely indicated. Therefore, it is a contingent asset which may be disclosed in notes if probable. However, income or receivable cannot be recorded. Okay. Let's do one more sum. So fourth sum also let's complete. It's a very small sum. Cash flow 1000 may be received in 1 year, 2 years, or 3 years with the probability of 10%, 60%, 30% respectively. Calculated expected cash flows using applicable discount rate 5%. Okay, let's do it tomorrow only. Basically, we need to do some theory for it. Okay, so let's stop for today, right? Okay, thank you.